The United States government owes $36 trillion. That's more debt than any nation in human history has ever accumulated. More debt than the entire global economy produced just 20 years ago. And here's what nobody's telling you. They're not planning to pay it back through taxes or spending cuts or economic growth. They're planning to make it disappear through a mechanism so subtle, so sophisticated, that most people won't even realize they're being robbed until it's already over. Right now, as you're watching this video, the Federal Reserve and Treasury Department are executing the most elegant debt elimination strategy ever devised. They're using inflation not as an economic side effect, but as a precision instrument to transfer $20 trillion in wealth from American savers, retirees, and bondholders directly to the government. And the beautiful part, from their perspective, is that it's completely legal, historically precedented, and politically invisible. You see, when the government owes $36 trillion in fixed-rate bonds, and they create inflation that makes every dollar worth less, they're repaying those bonds with money that has dramatically reduced purchasing power. If you lend someone $100 today and they pay you back $100 in 10 years, but those dollars now only buy what $50 could buy when you made the loan, you've been robbed of half your money. The government fulfilled their legal obligation, but they effectively defaulted on half the real value. This isn't theory. This isn't speculation. This is documented policy playing out in real time. And I'm going to show you exactly how it works, why it's accelerating right now, and what it means for your financial future. Welcome to Finance Historian. Here we break down global finance. Just a quick reminder. Before we get started, smash the like button and subscribe if you love financial deep dives. Comment your city and the time you're watching this. I want to see how global this community is. Let me start with something that should terrify every American. The government currently spends over $1 trillion annually just on interest payments. Not paying down the debt, not reducing what they owe, just interest. That's more than they spend on Medicare, more than national defense, more than everything except Social Security. 1/5 of every tax dollar collected goes straight to creditors before the government can spend a single penny on roads, schools, military, or anything else. And here's the mathematical reality that nobody in Washington wants to discuss. At current debt levels and interest rates, those payments will hit $1.8 trillion by 2027. That's 6% of the entire economy going just to service debt. There is no scenario, none, where the government can pay this through traditional means. You cannot tax your way out of 132% debt to GDP ratio. You cannot cut spending enough when interest alone consumes 6% of economic output. You cannot grow your way out when the debt is expanding faster than the economy. There's only one option, and they're executing it right now. The mechanism they're using is both brilliant and devastating. Instead of openly printing money to pay bills, which would cause immediate panic and currency collapse, they're creating controlled inflation that slowly but systematically erodes the real value of existing debt. Every percentage point of inflation above what bondholders expected when they bought government securities represents a transfer of wealth from those investors to the Treasury. Here's how the math works. If you bought a 10-year Treasury bond in 2020 at 2% interest, expecting 2% annual inflation, but actual inflation runs at 4% annually, you're losing 2% of purchasing power every year for 10 years. On a $1,000 bond, that's a $200 real loss. Multiply that across $36 trillion in outstanding debt, and you're looking at wealth transfers measured in the trillions. And the government has done this before, successfully, deliberately, with devastating effect on savers and massive benefit to federal finances. In 1946, at the end of World War II, the United States faced a debt crisis remarkably similar to today's situation. Federal debt had exploded to 106% of GDP, the highest level in American history. The cost of financing the war had pushed borrowing to unsustainable levels, and traditional economists predicted decades of economic stagnation under the weight of that debt burden. But something extraordinary happened instead. By 1974, just 28 years later, that debt had fallen to 23% of GDP. The government hadn't paid it off through surpluses. They hadn't grown their way out through unprecedented economic expansion. They had inflated it away through a carefully orchestrated campaign of currency debasement that destroyed the purchasing power of everyone who had lent money to Uncle Sam. Here's how they did it. From 1946 to 1951, consumer price inflation averaged 6.5% annually. That doesn't sound dramatic until you understand the mechanism. The average maturity of government debt in 1946 was 9 years, meaning most bonds would be repaid within that time frame. With inflation running at over 4% annually during the repayment period, the government was repaying creditors with dollars worth dramatically less than what they had borrowed. But here's the key insight that makes this strategy so powerful. Under normal conditions, inflation of 6% would have driven interest rates on government bonds through the roof. Investors would have demanded much higher yields to compensate for the loss of purchasing power. But the Federal Reserve, under pressure from the Treasury, artificially capped long-term government bond yields at 2.5% until 1951. Think about what this means. Inflation was running at 6%. Government bonds were paying 2.5%. That's negative 3.5% real returns for anyone holding Treasury securities. For 5 straight years, the government was paying creditors interest rates that were less than half the rate of inflation. Bondholders were getting destroyed, losing purchasing power month after month, while the Treasury celebrated as their debt burden evaporated. This wasn't an accident. This wasn't market forces. This was deliberate policy designed to transfer wealth from savers to the government through what economists call financial repression. The Federal Reserve artificially suppressed interest rates below inflation, creating negative real returns that made government debt essentially free while destroying the wealth of anyone foolish enough to lend money to Washington. And the results were stunning. Inflation reduced the 1946 debt to GDP ratio by almost 40% within a decade. Not through economic growth, not through budget surpluses, through pure monetary debasement that made existing debt worth less in real terms, while the government continued borrowing at artificially low rates. Now, the government will tell you this was necessary to recover from the war, that it was temporary emergency policy that allowed America to rebuild and prosper. But here's what they don't mention. The people who bore the cost of this debt elimination were American savers, retirees, and anyone who had bought government bonds expecting to preserve their wealth. Their purchasing power was systematically destroyed to benefit federal finances. And the most important detail that applies directly to today's situation. This strategy worked because the vast majority of government debt was fixed rate and denominated in dollars. When you create inflation, fixed rate debt becomes cheaper to repay, while new debt can be issued at rates that, if kept artificially low, don't fully compensate for the currency debasement. Today, over 92% of outstanding federal debt is fixed rate. Only 7.5% is inflation indexed. That means if inflation runs higher than bondholders expected when they purchased Treasury securities, the government wins and bondholders lose. And given that most current bonds were issued when inflation was around 2% annually, any sustained inflation above that level represents pure wealth transfer from creditors to the Treasury. But there's something happening right now that makes the current situation even more favorable for debt elimination than the post-war period. Something that could accelerate this process beyond anything we've seen in American history. The Federal Reserve has just finished the most aggressive monetary expansion in modern history. From 2020 to 2022, they increased the money supply by over 40%. That's more new money created in 2 years than in the previous decade combined. And while they've slowed the pace of expansion, the inflationary effects of that monetary injection are still working through the economy. Meanwhile, the Treasury has been issuing debt at historically low rates. Most of the bonds sold during the pandemic were issued when interest rates were near zero, meaning the government locked in extremely cheap financing just before embarking on the largest peacetime spending spree in history. Now here's where the strategy becomes truly diabolical. The government isn't just creating inflation and hoping it reduces their debt burden. They're actively manipulating the mechanisms that normally protect investors from currency debasement. Under normal market conditions, when inflation starts rising, bond prices fall and yields rise to compensate investors for the loss of purchasing power. This is basic economics. If inflation is running at 4%, rational investors demand at least 4% interest just to break even in real terms. But the Federal Reserve has spent the last 15 years conditioning markets to accept artificially suppressed interest rates through quantitative easing, forward guidance, and direct market intervention. They've created what economists call yield curve control without calling it yield curve control. Through their massive bond purchases, they've become the dominant player in the Treasury market, effectively setting prices rather than responding to them. When you're the largest buyer of government debt, you control what interest rates the government pays on that debt. And here's the beautiful part of their strategy. They can claim they're fighting inflation while simultaneously using it to eliminate debt. Every time they raise interest rates to combat rising prices, they're only affecting new debt issuance. The $36 trillion already outstanding remains locked at the historically low rates where it was issued. So they get credit for being responsible inflation fighters, while the vast majority of their debt gets cheaper to service in real terms. Let me show you the mathematical elegance of this approach. Research from the Congressional Budget Office demonstrates that even modest increases in sustained inflation have massive effects on debt reduction. If inflation runs just 1 percentage point higher than expected for a decade, it reduces the real burden of current debt by approximately 4%. That's over $1 trillion in effective debt elimination from just 1% of additional inflation. But if inflation runs 3 percentage points higher than the 2% target for 10 years, the real debt burden falls by 13%. That's nearly $5 trillion in wealth transferred from bondholders to the Treasury. And if sustained inflation hits 5% annually, 19% of the current debt burden disappears. $7 trillion erased through currency debasement. Now, the government will never admit they want higher inflation. Publicly, the Federal Reserve remains committed to their 2% target. But look at their actions, not their words. Despite inflation running above target for nearly 4 consecutive years, they've been remarkably tolerant of persistent price increases. They've revised their framework to allow inflation to run above 2% to make up for periods when it was below target. They've emphasized employment over price stability in their dual mandate. And most tellingly, they've consistently underestimated how long inflation would persist and how high it would go. These aren't forecasting errors. These are the predictable results of policies designed to generate sustained currency debasement while maintaining plausible deniability about the intent. But there's another dimension to this strategy that makes it even more effective than the post-World War II debt elimination. Foreign creditors now hold a massive portion of U.S. government debt. China owns over $1 trillion in Treasury securities. Japan holds nearly the same amount. Foreign entities collectively own about $7.7 trillion in U.S. debt. This creates a perverse incentive structure that didn't exist in 1946. When the government inflates away debt, foreign creditors bear a substantial portion of the cost. Chinese and Japanese investors who bought Treasury bonds expecting stable purchasing power are having their wealth systematically destroyed by American monetary policy. From a geopolitical perspective, this is brilliant. The United States gets to reduce its debt burden while imposing costs on strategic competitors. But it gets even better for Washington. These foreign creditors have limited options for retaliation. They can't dump their Treasury holdings without crashing the value of their remaining positions. They can't easily find alternative reserve assets that offer the same liquidity and scale as the U.S. bond market. They are essentially trapped in a system where American inflation policy systematically transfers their wealth to the U.S. Treasury. And the domestic political benefits are enormous. Nobody blames the government when inflation erodes the value of savings accounts and bond portfolios. People blame corporations for raising prices, landlords for increasing rent, and gas stations for higher fuel costs. The wealth transfer happens invisibly, spread across millions of transactions over years or decades. There are no headlines reading, "Government steals $5 trillion from bondholders through inflation." The mechanism is too complex and too gradual for most people to understand. Meanwhile, the government benefits are immediate and concrete. Every month that inflation runs above what bondholders expected when they bought Treasury securities, the real cost of servicing that debt falls. The nominal interest payments remain the same, but they represent a smaller claim on the economy's actual productive capacity. Consider what this means for those trillion-dollar annual interest payments. If sustained inflation runs just 2 percentage points above what creditors expected, the real burden of those payments falls by approximately 20%. That's $200 billion annually in reduced debt service costs, achieved not through budget discipline or economic growth, but through monetary manipulation that destroys the purchasing power of government creditors. And the beauty of the timing couldn't be more perfect. Most of the current debt was issued during the pandemic when interest rates were near zero and inflation expectations were anchored at 2%. Bondholders who bought 10-year Treasury notes in 2020 expected to earn positive real returns in a low inflation environment. Instead, they're getting nominal returns of 1 to 2%, while inflation has averaged well above 3%. These investors are experiencing what economists call financial repression in real time. Their government bonds are generating negative real returns month after month, systematically destroying their purchasing power while the Treasury celebrates reduced debt service costs. But the current strategy goes far beyond simple inflation. The government is also manipulating the tax code to accelerate wealth confiscation from savers and investors. While much of the tax system is indexed to inflation, the taxation of investment returns is not fully adjusted for currency debasement. When you earn 5% on a bond investment, but inflation is running at 4%, your real return is only 1%. But the IRS taxes you on the full 5% nominal gain, meaning you're paying taxes on inflation, not real economic returns. This creates effective tax rates that can exceed 100% of real returns, systematically destroying capital while generating revenue for government that's simultaneously debasing the currency those tax payments are made in. The mechanism is working exactly as designed. Corporate earnings reports show companies struggling with input cost inflation while consumers face higher prices across every category of spending. But Treasury auction results show continued strong demand for government debt at yields that remain well below the actual inflation rate. Investors are literally paying the government for the privilege of having their purchasing power destroyed, and international demand remains robust despite the obvious wealth transfer. Foreign central banks continue accumulating Treasury securities even as American inflation policy systematically erodes their real value. This isn't economic irrationality. It is the result of a monetary system where dollars remain the dominant reserve currency and treasury bonds remain the primary store of value for international reserves, regardless of their negative real returns. The Federal Reserve's recent policy adjustments reveal the sophistication of their debt elimination strategy. They've shifted from explicit quantitative easing to what they call quantitative tightening, reducing their balance sheet while claiming to fight inflation. But the timing and pace of this reduction is carefully calibrated to maintain artificial demand for Treasury securities while allowing controlled inflation to continue eroding the real value of outstanding debt. They're managing a delicate balance. Enough inflation to systematically reduce debt burdens, but not so much that it triggers panic selling of government bonds or collapse in dollar credibility. It's financial engineering on a scale that dwarfs anything attempted in human history, and it is happening right now while most Americans remain completely unaware of the wealth transfer occurring in their name. The sophistication of this debt elimination strategy becomes even more apparent when you examine the international coordination happening behind closed doors. While publicly maintaining their commitment to price stability, central banks across the developed world are executing remarkably similar policies that suggest coordinated currency debasement on a global scale. The European Central Bank, Bank of Japan, and Bank of England have all maintained negative or near zero real interest rates, while their governments accumulated record debt levels during the pandemic. This isn't coincidence. It's coordinated financial repression designed to allow simultaneous debt reduction across all major economies through synchronized inflation that makes it impossible for investors to flee to alternative currencies. When every major currency is being debased simultaneously, there's nowhere to run. European bonds offer negative real returns. Japanese government securities yield practically nothing while inflation accelerates. British gilts provide returns that fail to compensate for rising prices. Investors seeking positive real returns are forced into increasingly risky assets or simply accept the systematic destruction of their purchasing power. This coordination creates what economists call a prisoner's dilemma for international investors. Moving money from U.S. treasuries to European bonds, it doesn't escape the wealth transfer. It just changes which government is confiscating your purchasing power. The result is continued demand for government debt across all major economies, despite universally negative real returns. But the American strategy has several advantages over its international counterparts that make it particularly effective. The dollar's status as the global reserve currency means that even foreign transactions often require dollar holdings, creating artificial demand that supports treasury prices regardless of their economic attractiveness. Oil sales, international trade settlements, and central bank reserves all generate dollar demand that props up government bond prices. More importantly, the United States has successfully exported its inflation to other countries through the global dollar system. When American monetary expansion increases global dollar liquidity, it creates inflationary pressure worldwide, while allowing the U.S. to import goods at prices that don't fully reflect the currency debasement. Other countries experience the inflation but don't get the debt reduction benefits because their obligations aren't denominated in their own currencies. The timing of this strategy coincides perfectly with demographic trends that make it even more politically sustainable. As baby boomers retire and begin drawing Social Security and Medicare benefits, the government faces rapidly expanding entitlement obligations that would normally require massive tax increases or benefit cuts. But inflation allows them to fulfill these obligations in nominal terms while reducing their real cost through currency debasement. Social Security benefits are technically indexed to inflation, but the calculation methodology consistently understates actual price increases experienced by retirees. The Consumer Price Index used for adjustments excludes many costs that disproportionately affect older Americans, while giving insufficient weight to housing, healthcare, and energy expenses that consume larger portions of retirement budgets. This creates a secondary wealth transfer mechanism where retirees receive benefit increases that appear to maintain purchasing power but actually fall short of real inflation by 1 to 2 percentage points annually. Over a 20-year retirement, this seemingly small gap compounds into a massive reduction in real benefits that helps control entitlement spending without requiring politically unpopular benefit cuts. Medicare works similarly, with reimbursement rates and coverage decisions that fail to keep pace with actual medical inflation. Healthcare providers absorb some of these costs through reduced margins, but much of the burden falls on patients through higher out-of-pocket expenses that don't appear in official inflation calculations, but represent real purchasing power destruction for the people paying them. The psychological aspects of this strategy deserve particular attention because they reveal why it's so politically sustainable. Most Americans don't understand the relationship between monetary policy and inflation, making it impossible for them to connect currency debasement with their declining purchasing power. They blame grocery stores for higher food prices, landlords for increased rent, and gas stations for expensive fuel without recognizing these as symptoms of deliberate monetary policy. The $36 trillion debt isn't going anywhere through traditional means, but it doesn't have to. Through controlled inflation and financial repression, the government is systematically transferring trillions in wealth from savers and creditors to the Treasury, erasing debt burdens without ever missing a payment. This isn't economic policy. It's sophisticated theft executed through monetary manipulation that most people will never understand until their purchasing power has already been destroyed. The only question is whether you'll recognize what's happening and position yourself accordingly, or become another casualty of the most elegant wealth confiscation scheme in human history.